Hello and welcome to this video. I am Dr. Subayil Khan from subayil.com. So in this video, we will investigate the Microsoft stock a little bit and see if Microsoft is a good buy at the current price offered to us by the market, or in other words, will we get a good value for the price that we will pay for the Microsoft stock right now. So let's go ahead and diagnose Microsoft stock from a value centric perspective. So first of all, we all know about Microsoft, right? So most of us, if not all, have either used a PC at some point in their life, or else we use Microsoft Office on a daily basis or on a weekly basis. So here is the Microsoft website, just in case if you want to know a little bit more about the products and service portfolio which they have, which is quite huge actually. You can just go and have a look over here. So I won't spend much time on that. So let's dive right into the value centric dimensions and numbers that we need to know. So here we have the different numbers which are quite important. So the current price for the Microsoft stock is $301 US. The market cap is 2.278 trillions. The PE ratio currently, which is over the trailing 12 months, is 37.2, which is quite high. Normally I look for a PE ratio of 20 or less. The PEG ratio is 3.2 over the trailing 12 months. Normally I look for a PEG ratio which is less than 1. But since Microsoft is a very big company and I don't expect it to grow quite fast or as rapidly as some startups do, therefore that is not a very big thing. Earnings per share is 8.05 US. The price to book ratio is 16. The price to sales ratio is 13.6, and the price to free cash flow is 36, which is again quite high. And then the average revenue growth is 14%, the average asset growth is 6%, average equity growth is 11%, and the average net income growth is 38%, while the average liability growth is 4%. And this is over the time frame of 3 years. So if I change it to 5 years, let's see what happens. So the average revenue growth over this time frame is 9%, the asset growth is 12%, and the equity growth is 9% again. The average net income growth is 41%, and the average liability growth is 15%. Now if we switch to 10 years, this is what happens. So 8%, 12%, and 10% respectively. And then the average net income growth of 17% and average liability growth of 15% during this time frame. And over here we can see that the total revenue of Microsoft has been on a steady rise since 2010, which is remarkable for a company of this size. And the net income, even though it has been going up and down at times, and it became quite low in 2015, but then we can again see that it is on a steady rise too, and that was over a time span of 10 years. But over here, if we look at a shorter time frame of 5 years, we can again see that the total revenue is increasing, and also again the net income is increasing. There was just one anomaly over here, which was 2018. So we have to see what happened during that year. Maybe there were some acquisitions, maybe the company changed its strategic direction a little bit. So we can look into the year 2018 and see what happened over there if we want to, but that is beyond the scope of this video. The total assets over total liabilities, we can see the blue graph. So it always stayed above 1, which means that, which is quite good actually. And it shows that the health of the company is okay. Also, the total current assets over total current liabilities, again, this graph has always stayed above 1, which shows that the total current assets are always more than the total current liabilities. Same is the case of total assets and total liabilities, by the way. So again, over here on the shorter time frame, the 5 years, we can again see the same thing. Of course, it is just a a zoom in of this graph. So nothing much different over there, but still it is good to look at the things over shorter time frames, starting from a big time frame to see the overall big picture. So over here we can see that from 2016 to 20, the ratio of the total assets and total liabilities has always stayed above 1. So the total assets always lead the total liabilities or are more than them, which is quite good. And then the total current assets over total current liabilities, again, they have stayed even above the total assets over total liabilities ratio. The same goes for even a shorter time frame of 3 years, so that is quite evident. And now we look at some of the key ratios. I'm especially interested in PE ratio. So if we look over here and focus on the gray bars, we can see that the PE ratio has been quite good in 2010, 11, and then in 2013. The stock was quite discounted because what I look for as a value investor is to get a good value for what I pay. Over here we can see that in 2018, wow, the PE ratio is 45. So in that case, it simply means that the stock was too much overpriced, and it will take a lot of years, 45 years, for the earnings of the share to add up to be equal to the current price of the stock at that point, right? So this is how it works. Also, we can see that, okay, fine, the price to sales ratio has been steadily going up, and also price to book ratio has been steadily going up. Price to earning ratio is very important. So it tells us about the market sentiment and helps us in finding the right entry points or times at which we can accumulate the stock for a discounted price rather than being caught up in the hype. So after 2018, the price to earnings ratio has gone down a little bit, but I will like it to go further down in between 15 and 10, so that then I can press the trigger and make it a part of my portfolio steadily. And looking at the key growth rates, so the total assets growth is shown in gray. So over here we can see that there has been not a consistent pattern that we can figure out. So it is not like a steady increase or let's say a steady decrease, but it has been fluctuating quite a lot. And same is the case of total liabilities and total equity growth also. So feel free to stop the video over here and look at these important rates year over year if you want to. But if we look at the things over a shorter time frame, once again, we can see that the total asset growth, there is a steady decline that we can see. The total liability growth, again, a steady decline. But the equity growth is just all over the place. I mean, up and down and negative and positive and pretty much topsy-turvy. But it is what it is. The return on equity and the return on invested capital, that is very important because it shows how competent the management is and how efficient the company is in creating value for the targeted market segment or its targeted market segments. So we can see that the return on equity and return on invested capital, both of them have been growing year over year since 2010 and 2020. Over a much shorter time frame, like 5 years, we can see again the same pattern, and even on a shorter time frame, which is 3 years, we can see the same trends. And as far as the margins are concerned, wow, the gross margins are pretty high, and that is pretty much the case with many software companies. And same is the case of EBITDA margin and operating margin. And if we look at the shorter time frames like 5 years and 3 years, once again we can see that things are just simply moving up now. So from 2010 to 15, the things were just on a very slow downtrend, nothing drastic. But since 2015, right here, the things have been on a steady uptrend. As far as the diluted shares outstanding are concerned, we can see that the number of shares outstanding are decreasing steadily, which simply shows that with time, each share will be worth more for the investors anyways if they just hold on to it. And this trend becomes more and more profound as we look at the shorter time frames, or let's say when we zoom into this big picture from left to right. Since 2016 to 2020, the number of shares outstanding have gone down tremendously, and the trend has been even more profound over a time frame of 3 years. And as we can see over here, the free cash flow has been growing since 2011 till 2012, and the growth decreased. No, I'm not saying that the free cash flow was negative or something now, but it is the growth rate, right? So please look at the difference in wordings a little bit. So, and since 2016 again, the growth rate has been positive, so which is quite a healthy sign. And now if we look at the investment feasibility score over an 11-year time period, we get a 71% score out of 100. If we look at a time frame of 5 years, it is 86%, which is outstanding for a company of this size. And then over a period of 3 years, we can see that the score has hiked to 93%. It will be very hard to find a company with a market cap in trillions to have such consistency and such brilliance. So now the question is, will I buy the Microsoft stock or not? So let's go to TipRanks and see the current state of the market a little bit. Out of 26 ratings from analysts, all 26 are a buy, and they have an average price target of $326 US, and the highest price target is $411 US, with the lowest price target of $275 US. So looking at the overall picture, we can see that the analysts agree on it as a strong buy, and the sentiment from TipRanks investors is very positive too. The new sentiment is also very bullish. The blogger's opinion is also very bullish. But here is something important. The hedge fund activity has decreased by 5.3 million shares in the last quarter. And I will tell you why is it the case. And the return on equity is 47.08%, which I already talked about, that the ROE or return on equity has been quite good over the larger time frames and also over the shorter time frames. And let's have a look at the chart of Microsoft. Just look at the price, guys. It has just gone up and up and up. Over here in 2020, we did get a correction, but then it has just been on a steady rise. And if we look at the PE ratio range, so in 2019, Mr. Market offered it to us for a very discounted price, which was 17.77 of the PE ratio. Because the markets are emotional, they are pretty much sentiment driven. And the business model of the companies, especially the big companies like Microsoft, their overall spectrum of value proposition, their products, services, and so on, they don't evolve as fast as the sentiment of market evolves. So you see over here in 2019, some people did pay a very high price for the value that they got, which was 29.43 of PE ratio, and some savvy investors scooped it for a PE ratio of 17.77 US. In 2020, it was a no-go territory for me, so I would have not bought the Microsoft stock in 2020. Why? Because the PE ratio is above my maximum threshold, that is 20. And some people even paid a whooping price for the value which they got when the PE ratio climbed up to 37.02. And in 2021, well, we still have some months to go. So we have 4 months to go. So I can see this range definitely widening a little bit, or at least it is the most likely scenario, but nothing is guaranteed. So the maximum value that I would have gotten for what I had invested was like the PE ratio of 25. So earnings accumulated over 25 years would be equal to the price if I had bought it at the best time in 2021. So look at the things from a value-centric perspective. And as we can see, the hedge funds holdings are steadily going down. And why is it the case when the price is going up? So since June 2019, the hedge funds have been steadily and slowly offloading the Microsoft stock, even though the price was increasing. So the retail investors and non-savvy investors, they were buying, they kept on buying, and that is what actually pushed the price up. But when the hedge fund saw that, okay, fine, it is not a good value centric play right now, they just simply steadily offloaded the Microsoft stock. And as is normally the case, they pull the money out of stocks that are overpriced and look for good value plays that are lurking around in the same industry or in different industries, so that their money can go a long way and they can get a good return for the money that they invest. And this is how savvy investors work. So what is my opinion now? What are my final thoughts about the Microsoft stock? So looking at tip ranks and the positivity among the analysts, I simply disagree with them. So Microsoft is a huge company, and the companies that are very big, they normally grow slowly. So looking at the strong fundamentals and the good financials of Microsoft, I definitely want more of Microsoft stock. But when the PE ratio drops below 20, or if there is a crash in the market, when the people are fearful, this is where I will start accumulating, not now. So right now, the market is not offering me a discount as a value investor. I strive to get more value in return for the money that I invest, and I'm quite strategic about it. So the fundamentals are great. I trust the CEO. I love the company and its strategic direction. But it is just that I won't be getting a good value that I desire with the current price that the market is offering me. So that is all what I have to say about the Microsoft stock. Thank you very much for watching the video. If you like the content, please subscribe, press the notifications bell, and like the video please, because the YouTube algorithm likes it and it helps my channel grow, and I strive to bring such quality content even in the future to you on regular basis. Thank you very much for your time and have a wonderful day. God bless you. Bye.